Hello and welcome to another tutorial from Simple Trading Ideas. Today's Simple Trading Idea will be based upon revisiting the equity curve, or shall I say, today's trading ideas will be based upon revisiting the equity curve. So, without further ado, let's dive in and take a look at an equity curve. Okay, here we are back in an Excel spreadsheet with a real-time actual equity curve. The previous one we looked at in our introduction to equity curves, entitled What is an Equity Curve, simply was constructed of a series of $1,000 winners for the purposes of simplicity. Those particular winners stacked on top of each other created an equity curve with a 45-degree angle that basically went from the lower left-hand corner all the way up to the upper right-hand corner. And it was a beautiful looking equity curve. However, as we discussed previously, it was unrealistic to expect winner after winner after winner after winner after winner after winner and never experience a loss. Therefore, that particular equity curve did not have a dip in it. This one quite obviously has lots of dips in it. And many people would look at this and think, well, I would have loved to have been in at this particular point when there was a great deal of acceleration. You can see that particular angle there, but wouldn't really be that thrilled about being from here at this point down here, or as it meanders around here. Now, let's talk about a couple simple trading ideas that can be implemented in order to actually trade not only based upon the trading system or methodology itself, but trade based upon the equity curve. Now, there are a number of different ways to do this. One simple way, of course, is to create a moving average of the equity curve. And every time the equity curve crosses over the moving average, you continue to trade. When it crosses below the moving average, you stop trading. This may not be a new concept to some of you, but I'm certain that some people are thinking, okay, what are you talking about? Okay, so let's jump back in. Another way to trade the equity curve is simply to use peaks and valleys or horizontal lines even. So someone could conceivably trade along and continue to trade. Then the equity drops below, closes below this particular horizontal line. They could stop actually trading, and then when it closes above there, they could continue to trade, and they get kind of whipsawed. Again, this does happen. Long again, back trading again, and here where you stop trading, and back here where trading resumes. Okay, trading resumes, and these lines can be closer together or whatever you happen to choose based upon your own research, of course. Obviously, you don't want to just jump in and do this, because if you just jump in and haphazardly do it, then it's kind of like about as bad as not having a trading system at all. Okay, so again, back up here, and it crosses below there, back up again, and you can see that that can whipsaw you. So you've got, that's a horizontal line method of doing it. You could also do it based upon peaks. Okay, so you could go up here and say, hey, listen, okay, that's an equity high, drops below there, and said, well, I'm not going to get back in and trade again until we break that particular high. And it's going to take some thought in order for things to work out for you. For me personally, this particular equity curve, I actually stopped trading it right around here. So all this particular time here, this is actually months of time when the trading system and the market were obviously not in perfect sync. Okay, so this is all types of these are all types of trades that I didn't participate in because I chose to wait for a new equity peak before I entered the trade. Now, from practical standpoints, that's a lot of transactions. You're in markets where transaction costs are a factor, and they're a factor in all markets. So, any market you're in, it's also time. Okay, to be able to just look at a glance and say, okay, well, hey, I don't have to do anything at this particular time. Okay, I don't have to make a trade. You could start and you could say we're doing this equity peak. You can see that it's not there. Okay, nothing's happening. So all across here, you've saved a lot of time not entering trades. Okay, not fooling around with any trades, and this, of course, could give you an opportunity to allocate those particular financial resources and shift them in a different direction. When one shuts off, you can go back and send fuel in another direction. So it's sort of like having a piston or cylinder inside of a car, piston inside of a car, and that particular one stops functioning as it should, so it doesn't really make sense to have fuel pouring in there. So you would divert the fuel into where the other pistons could fire inside the cylinder and provide your overall portfolio equity with some movement. Okay, so let's move on to another equity curve. Okay, this is another one of my personal favorite systems. A lot of people would look at it and go, "Ooh, that zigs and zags." Well, real-time, real money trading systems do zig and zag. The point is that, as before, you move from the lower left-hand corner of the equity curve to the upper right-hand corner. Sometimes it's not exactly pretty how that might be done. So thinking about what we chatted about last time, how specifically might we trade this particular equity curve to our advantage? Again, there's horizontal line. Okay, 5,000. We're involved. Okay. We get uninvolved. Okay. We're involved, uninvolved. We're involved. We continue to be involved. We're uninvolved until here again. We're involved. And again, this could be done not just with the horizontal lines, but with the equity peaks as well. This is essentially some food for thought, some seeds for further trading research that may prove to be helpful to you as it has been helpful to me. Now let's take a look at another example and why this can make so much sense in your trading. Okay, so now we're looking at, yes, this is a system that I traded, and I'll tell you exactly what happened here. Okay, started off sporadic, but it did show some promise. It came down to a drawdown here that wasn't quite 50% of the equity. Moved up to a peak here, and at this particular point, October of last year, near the end of October last year, I think it was the 27th, that's where we had the equity peak. And right around the 1st of November, is when I stopped trading this system. So all this movement downward, 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 I did not participate in. Okay, I did not participate in. So why is this useful? Well, this is useful because the trading system that you're using, and even some of the ones that are working fabulously now, there's no guarantee that any of them is going to go through every single market condition that you'd like for them to and end up with flying colors. Okay, this is an example of one way to know when to stop trading a system, rather than when all the money's out of your account, of course. When the money's all gone out of your account, that choice isn't yours at that particular point. But you can allocate, again, you can reallocate the money that were used to trade this particular system and place it in another system that is bearing more fruit, such as this particular system, for instance. And that's what was done here. So again, to answer the question when to get out of when to stop trading a particular trading system, there are a number of different metrics, of course. And some people may say that your metric is going to depend upon your particular trading system. Now, if your maximum drawdown in your trading system has been 30% and of equity, and you're approaching 50% of equity, then I'm not going to say that's a terrible thing, but it's it's certainly not. Certainly the system isn't necessarily in tune with the market, but a 50% drawdown in a healthy trading system, dependent upon the other parameters and the risk-reward ratio, is not something that's unheard of. I see many people would balk at using it, but again, it's a matter of your own personal trading style, your threshold for financial pain, because some systems, with especially long-term systems that I trade, have huge drawdowns, but when they catch the market and get in sync with it for a long period of time, the rewards are very, very well worth it. All right, listen, thanks for joining me for another in a series of simple trading ideas.